Today, we're going to be looking at ways that you can save money on taxes. We are going to be looking at the real life example of a client of ours here in the state of Georgia, and we've changed their name to protect the innocent, so to speak. But let's go ahead and dive right in. As you can see, this particular couple is in a position where they have a total income of about $278 before their above the line AGI deductions, which are going to be take them down to $275. They paid almost $44,000 in tax. They're in the 24% bracket, and their average rate is only about 16%. They did have some qualified ordinary dividends here, and then short and long-term capital gains, none there. Carried forward loss credits, claimed only $2, which is interesting. And then we're going to look at the breakdown, and you can see that this particular person was self-employed. So those are the taxes they paid, only $5 on the long-term gains. What we're going to be talking about today, these are things that you can apply regardless of your tax bracket. A lot of these things that we'll be talking about are not just exclusive to the 24% bracket. So we're going to go ahead and we'll be looking at all those. As you can see here is their long-term capital gains and qualified dividends tax. If you look at that, you'll see you really have to go over $583,000 to get to that next 20% bracket. And then for a married couple, once you go over $94,000, you're taxed at 15% on your long-term capital gains and qualified dividends. We go over here to Schedule D, and you can kind of see this. Not much excitement there. And then we want to look at the tax efficiency. This is the kind of things we go over here with our clients talking about the tax efficiency. A lot more non-qualified dividends. So even though it's only $250, it could be much, much more than this. And it is with some of our clients. And so we kind of want to you pay a lot less on qualified dividends than you do non-qualified dividends. And we'll talk about that in a moment. And then we just want to make sure that you can see here while I'm scrolling through here. If you want to pause the video, you can look at the different definitions of the modified adjusted gross income that the government uses. Here's the formulas down here as well that we found helpful. And we hope that you can look at these and understand. And then deductions and credits. So you can see, again, they get to deduct about $3,200 on the self-employment, the standard deductions here. And then they had qualified business income deduction of $32,150. So as we look at the observations on this particular tax return for this couple, we can see that less than 50% of their dividend came from qualified dividends. And then, I'm going to recommend that they consider reviewing their portfolio to determine the percentage and see if we can go ahead and reduce the amount they're paying on dividends. I think we can get it down. We need to make sure that they're holding their stock for 60 days, their preferred stock for 90 days, and that the corporations that they're investing in are also in the U.S. Now, if all these dividends came from foreign stocks, then we've done an excellent job if their portfolios only produced that much in dividends from the foreign stocks. So we'll just have to look at that. Because we do have our clients put some of their money in overseas stocks. It's not just all 100% in U.S. stocks. So they're in the 24% bracket, and they can do a Roth conversion. This allows them to move pre-tax retirement savings to a Roth IRA for future tax-free growth and withdrawals. They will owe taxes on the converted amount, of course. Then they have the 5-year rule as far as taking the withdrawals out that they moved over from the Roth, and then the RMD requirements. When they turn 73 and they start making those RMDs, they're not going to be able to use the RMDs as a Roth conversion. And then this just gets into the safe harbor and kind of for them to avoid underpayment penalties for next year, for 2025. This is looking at their 2024 return, by the way. And then we have the modified adjusted gross income that they're not eligible to contribute to. They, of course, have business income, and they can implement a retirement plan, which would save them on taxes tremendously. They can contribute up to $23,500. Plus, if you look right here, the husband is between the ages of 50 and 64, and so he's eligible to make a catch-up contributions to his retirement plan, so he can contribute an additional $7,500, which would save them around $2,250 in federal and state income taxes for the year. Also, their tax return does not include any HSA contributions, which would be another $8,550, and this would save them about $2,565 in federal and state income taxes at their current income level, because the state of Georgia does have an income tax of a little over 5% in 2025. Now, the reason that I think these are great for folks is that they offer a triple tax advantage. And they really are one of the most uniquely treated contributions or finance items in all the tax code. So your contributions are going to be made pre-tax, just like a traditional IRA or a 401k. The money grows tax-free like a Roth. And then the withdrawals for qualified medical expenses are also tax-free, just like a Roth. So you have flexibility with it. It's yours for your whole life. It has investment growth potential. You can put it into stocks and it can grow. And it doesn't have a use it or lose it rule where you like a flexible savings account does, which is great for the health savings accounts. And then the other thing about the health savings accounts is that you can open an HSA, even if your employer doesn't offer one. So as long as you have a qualifying high deductible health plan. And then a beneficiary designation. If you die before you use it, you can have beneficiaries and leave it to them as well. And remember, once you hit 65, you can pull the money out for reasons that are non-medical, but you also can't make contributions to it anymore if you get onto Social Security at the age of 65. So as you can see, meeting just quickly, if the client just does a couple of these things, and that doesn't even include the 529 down here if they have children or even grandchildren. So this just talks about the clean credit vehicle they can do. And then here's some items in the state of Georgia for them to know. Taxpayers 65 and older can exclude up to $65,000 of retirement income. But what I want to do is go back here and talk a little bit about this backdoor strategy on the Roth, backdoor Roth. On a Roth backdoor, it's not a special type of IRA. It's actually rather a strategy for high income earners who are otherwise ineligible to contribute directly to a Roth IRA due to IRS income limits. And this gives them the benefit to still take advantage of the benefits of a Roth IRA. So here's the two-step process. What you want to do is you want to contribute to a traditional IRA. So you're going to make non-taxable, after tax, that means, contributions to traditional IRA. Then once you do that, you'll go ahead and convert those funds from the traditional into the Roth IRA. Now, the good news is that there's no income limits for converting a traditional IRA to a Roth, which is why this works well for high income earners. So why would you want to use a backdoor Roth strategy? Well, number one, you get the tax-free growth. Once the money's over at the Roth, you never have to pay taxes on it again, and people are living longer and longer and longer. And it doesn't take much time for this to end up being a really good move. Number two, you have those tax-free withdrawals. You can withdraw, qualified withdrawals in retirement are also tax-free from a Roth, as we know, and when you're over the age of 59 and a half, and then you can also bypass income limits. This strategy allows high earners to really get after it. I mean, they can really get some money into some Roth IRAs with this particular strategy. And so it's a beautiful thing. The higher your income goes up, you can get a lot of money into Roths if you're making a lot of money. So importantly to kind of note on this Roth is that it is legal and it's acknowledged strategy by the IRS, but it can have tax complications, especially if you have other pre-tax IRA balances. So you want to be careful there. One way around that is to open up a traditional IRA and just go ahead and make non-deductible contributions to this brand new IRA that has a $0 balance when you open it, and just use it as your backdoor traditional IRA. So in summary, the backdoor Roth is really a wonderful workaround for high income individuals to fund a Roth IRA by first contributing to a traditional and then converting it. And you can see the state of Georgia tax is going from $539 in 24, it's dropping it to $519. But if we look at this, we'll see that we found just a couple of items here for this couple with the catch-up contribution and then the HSA, that would save them about $4,800 in taxes for 2025. And I'm not even counting them starting a 401k plan and contributing to $23,500 there. I hope this video has been helpful to you. We're going to be putting out more videos. What are you doing to save money on taxes? I'd love to hear in the comments below. If you have any other questions from this video, put those in the comments below and I'll answer them. And as always, I would appreciate you liking and subscribing because we will continue to put out more content to help you be a better steward of the money that has been entrusted to your care. Thanks for tuning in, and we'll see you next time.